What's up, bag chasers? Welcome back to the channel. It's your boy, and you already know the mission. We slice through the hype, we go straight to the receipts, and we figure out how to chase that bag. Today we are tackling an absolute beast, a titan of the game, JPMorgan Chase. Yeah, their Q4 earnings just hit the streets, and you know the headlines are going crazy. But we don't follow headlines here. We do the deep work. So you're going to want to stick around because we are about to make the call on whether this stock is a certified bag.
All right, let's lock in. The mission today? It's simple, but it's everything. We're going to rip this earnings report open and see what's really inside. We're going to look right past all that slick corporate jargon and the big, shiny numbers they flash on TV. Nah, we're on the hunt for the real story, the alpha, the little details that show you where the money is actually moving. And by the time we're done, you and we're making a call. Is JPM stock a secure, something we're adding to the portfolio? Or is it a drop, something we wouldn't touch? Let's get into it.
Okay, first things first. Before we start digging around for the buried treasure, we gotta pop the hood and check the vitals. Anytime you look at a company, you gotta start with these headline numbers. These are the stats they blast on the news, the ones that make the stock jump or tank in the first 5 minutes of trading. It just gives us a quick health check, lets us know if the patient's even breathing before we go in for surgery. So let's see what JPM is working with. And we are starting off hot. Just look at this number right here. $13 billion with a B. That's their net income for 1 quarter. That means after all the bills are paid, salaries for their army of employees, rent on skyscrapers all over the world, you name it, they still put $13 billion of pure profit in their pocket in just 3 months. That is an insane number, and it tells you right out of the gate that this company is an absolute cash printing machine. But profit alone isn't the full picture. We got to know how good they are at making that money.
Which brings us right here. 18%. Now this is their ROCE, Return on Tangible Common Equity. Okay, I know, it sounds complicated, but I promise you, this is high-key one of the most important stats for any bank. It basically tells you how good they are at making profits from the money shareholders actually put in the business, the real hard capital they have to work with. And listen, an 18% ROCE is seriously strong. It shows they're not just huge, they're efficient. They're making their assets sweat. Now, what's really interesting here is, whoa, hold up. Run that back for a sec. ROCE? What's that even mean? Break it down for us.
My bad. Good call out from the producer. Let's break it all the way down. Peep this slide. So think of it this way. A bank owns a ton of stuff, right? Some of that stuff is tangible, real things like cash, buildings, the actual loans they've made. But some of it is intangible, like the value of their brand name or this weird accounting thing called goodwill. ROTE is great because it just throws all that intangible fluff in the trash. It asks one simple question. For every real, hard dollar of capital you have, how much profit are you making? So that 18% we saw, it means for every tangible dollar they have on the books, they're cranking out 18 cents of pure profit. It's the real measure of their hustle. Bottom line, it's a killer number. They're not just rich, they're smart.
And our last vital sign right here, $4.63. This is the earnings per share, or EPS. This is just that giant net income number we saw, but it's chopped up and divided by all the shares out there. It's the number Wall Street gets obsessed with. And yeah, it's solid, no doubt. So quick recap on the vitals. They're making a mountain of cash, they're doing it super efficiently, and the per share earnings look pretty healthy. On the surface, man, JPM looks like a heavyweight champion, but you and I know the real story is never just on the surface.
All right, now we get to the good part. This is where we separate from the crowd. Those headline numbers, they're clean, they're strong, cool. But a company this big can hide a lot of stuff in plain sight. The real alpha, right? The info that gives you an actual edge, it's always buried deep in the footnotes. I call them the side pockets, these big, strategic, sometimes super risky bets that a company's making that don't always show up in the big, bold numbers. And trust me, JPM has a couple of wild ones this quarter.
Boom! And there it is, our first major clue. I'm highlighting this quote for you right now. This is straight from their report. Pause if you got to read it. They set aside $2.2 billion. Why? To buy the Apple Card business. Just let that sink in for a second. This is a monster power play. They are betting billions of dollars to basically become the bank inside the iPhone, to get inside the daily lives of millions of the most loyal, highest-spending customers in the world. Goldman Sachs couldn't make it work, and now it looks like JPM is swooping in, ready to own that space.
And this isn't just some promise for the future. No. Look at this chart right here. That line, Apple Card impact, that is a direct hit to their capital. their main safety cushion, that they took right now. They are literally making themselves weaker and taking on more risk today, all for a bet that they think is going to pay off big time down the road. This is exactly the kind of side pocket we hunt for. It's a huge, expensive gamble that tells you exactly where their head is at and where they plan to grow.
So that Apple deal is big and flashy, right? But everyone's talking about it. The second side pocket? Well, it's a lot quieter. It's a little more murky. It's about who JPMorgan is really doing business with. I mean, we all know they lend money for houses and cars, and they lend to big companies like Ford or whatever. That's standard banking. But there's this other group they've been lending a ton of money to, a group that's been growing like crazy in the shadows. And it forces us to ask the real question: where is JPM's biggest risk actually hiding?
And this chart says it all. Check this out. It shows they're lending to something called non-bank financial institutions, or NBFIs. Look at that line. It has gone completely vertical. It has absolutely exploded. We are talking about $160 billion of exposure. This isn't a loan to your local coffee shop. This is a massive concentrated bet on a very specific and, let's be honest, very sketchy part of the financial world. The sheer scale of this is mind-blowing. Wait, NBFI? Hold up. Show us the receipts on what that is. What exactly are we talking about here?
Perfect question. Let's get the definition up. So an NBFI is basically any company that acts like a bank, lending money, creating credit, but isn't regulated like one. This is the wild west of finance. We're talking private equity firms, huge hedge funds, private credit funds, the whole world that people call shadow banking. And why is it called that? Because they operate with fewer rules, way less transparency, and they often take on insane amounts of risk that a normal bank would never be allowed to touch. And JPMorgan, they're the bank for these shadow banks. It's a super profitable business, but man, it comes with a ton of hidden danger.
And look at where this money is going. This is so important. They are on the hook for $62 billion to mortgage companies that operate outside the normal system. Another $58 billion to private credit funds that are literally trying to eat JPM's own lunch. $50 billion to those buy now, pay later companies and other consumer lenders that are super risky. Every single slice on this chart is a different flavor of potential disaster, a different way this whole thing could blow up. And JPM is backstopping all of it. For me, this is the single biggest red flag in this entire report.
Okay, so we've looked at the secret side bets, right? The risky plays. Now we got to get back to basics and check the main engines. We have to see if the core business is strong enough to actually support these kinds of gambles. I mean, it's one thing to make crazy bets when your main gig is struggling, but it's a whole different story when you're operating from a position of absolute power. So let's do a quick lightning round through their main divisions and see how solid that foundation really is. First up, consumer and community banking. This is the bank you actually see on the street corner, the Chase branches, your credit cards. They raked in almost $20 billion in revenue, and even after they put away all that money for the Apple deal, they still had a return on equity of 25%. That is massive. This part of the bank is an absolute fortress, a cash machine that just keeps sprinting year after year.
Next, let's look at the Wall Street division, the commercial and investment bank. They didn't just do well, they absolutely crushed it. Look at that, $7.3 billion in profit, almost double the consumer bank. The report said their traders basically printed money in the stock market this quarter. When things get crazy and markets are volatile, these are the guys who win. This engine is firing on all cylinders.
And last but not least, asset and wealth management. This is where they manage money for billionaires and huge institutions. And look, these numbers are just ridiculous. Peep that return on equity. 44%, 44. That's just an insane level of profit. For every single dollar they have invested in this business, they're making 44 cents back in profit every year. It's a cheat code. So let's be perfectly clear. The core businesses, they are unbelievably strong.
Okay, so the main hustles are rock solid, but they're making some sketchy side bets. So what's next? This is maybe the most important part of the whole analysis. We got to look into the crystal ball. This is where the company's own management team tells us what they think is going to happen next year. Their guidance tells us everything. Are they feeling bullish, or do they see clouds on the horizon?
So let's break down their forecast for next year. On one hand, they think their core lending profits are going to stay super strong, around $95 billion. That's a huge sign of confidence. They also said expenses are going up, but that's mostly to pay for things like that Apple deal. But, and this is a big but, look at that last point. They are straight up telling us that they expect more people to default on their credit cards. So what's the takeaway? They think the bank is going to make a ton of money, but they're also warning us that the average person is starting to struggle. It's a really weird mix of confidence and caution.
All right, bag chasers. This is it, the moment of truth. We've checked the vitals. We've gone deep into the risky side pockets. We confirmed the main hustles are absolute tanks. We even looked into their own crystal ball. We have all the receipts laid out right in front of us, so it is time to weigh all the evidence and make the final call. Is JPMorgan Chase a stock we secure for the bag, or is it a drop?
Let's just put it all on the table. The bull case versus the bear case. On the bull side, the argument is simple. The profits are gigantic. Their core businesses, especially the investment bank and wealth management, are just printing money. And they're making smart, aggressive bets like the Apple Car deal to lock in future growth. But that bear case, it's pretty scary. That massive exposure to the shadow banks is a huge, dark cloud of risk that we can't fully see. The Apple deal costs them a lot of capital right now, and they are literally telling us to expect more of their own customers to go broke. It's a classic fight, a fortress-like core business versus some really, really risky side hustles.
So, after going through every single receipt, after weighing all the risks and all the rewards, the verdict is in. We are officially calling JPMorgan Chase a secure. Now listen, this is not a stock for somebody who's scared of heights. You have to watch that shadow banking number like a hawk. If that system starts to crack, JPM is going to feel the pain, for sure. But for a long-term player, the foundation here is just too strong. It's a fortress. They have the pure financial firepower to take the hit from the Apple deal and to handle some rising credit card defaults because their main businesses are just that profitable. The strength is just too overwhelming to bet against. We're securing this bag.
But hey, that's just my analysis. The one big question I want to leave you with is this. What happens if that shadow banking system really does start to crack under all this pressure? Is JPM's fortress really strong enough to handle that kind of storm? That $160 billion question is the whole ballgame. So drop a comment below and let me know what you think. Are you holding JPM stock? Are you buying more? Are you selling or are you staying away? Let's chop it up in the comments. Until next time, bag chasers, stay sharp and keep stacking. Peace.